If you're wondering how you can improve your credit score, then stay tuned. I'm going to talk about 7 ways you can try to improve your score and how this can help you get the best deals for credit cards, personal loans and mortgages. If you're new to this channel, I'm Matt. I've been a finance consultant for over 10 years, working for one of the top consulting companies in London. I now run my own company, and on this channel I talk all things personal finance. So let's start by explaining what a credit score is. A credit score is a sign of how healthy your credit report is, and lenders will use this to check whether you're a reliable borrower. It can impact whether you get accepted for loans, credit cards or mortgages. One of the main credit report providers is Experian, and they show credit scores in the following categories, ranging from 300 to 850. A credit score of 670 or above is generally considered good, and a score of 800 and above is considered to be exceptional. Most consumers have a credit score that falls between 600 and 750, and last year the average FICO credit score in the US was 715. Achieving a good credit score can help you qualify for a credit card or loan with a lower interest rate and better terms. So why is having a good credit score important? According to Experian, most lenders require a minimum credit score of 620 to buy a house with a conventional mortgage. Your credit score plays a role in determining the interest rate and payment terms on a loan, and lenders will base the interest rate they charge on how risky they view you as a borrower. So while it may be possible to get a mortgage with a bad credit score, you're typically better off improving your score before applying for a mortgage to qualify for good terms. For example, the difference between taking out a 30-year fixed rate $250,000 mortgage with a 620 FICO score versus a 670 FICO score could be over $160 per month. That's extra money that you could be putting towards your savings or investments. And over the lifetime of the loan, having the better score could save you over $57,000 in interest payments. So what influences your credit score and how can you improve this? FICO uses percentages to represent generally how important each category is and considers scoring factors in the following order. Your payment history is 35%. The amount you owe is 30%, the length of your credit history is 15%, the mix of your credit is 10%, and any new credit you have is also 10%. Although the exact percentage breakdown of your credit score will depend on your unique credit report, these percentages can give helpful guidance. And based on this, I've got 7 ways you can improve your credit score. Firstly, make sure you pay your bills on time. If you have a deadline to make a payment by, make sure you hit it, as it shows on your records and demonstrates to lenders that you're able to make a payment when you're supposed to. Missing payments, having an account sent to collections or filing bankruptcy could hurt your scores, and having a late payment history stays on your records for a number of years. So a couple of tips to help you with this. Set up direct debits for a few days after payday so you have the money in your bank account ready for any direct debits being taken out for regular monthly bills. And if you do have any late payments, speak to your lender or provider and agree the plan to settle those payments over an agreed time period so they don't show as late payments going forward. The second way to improve your credit score is reviewing your credit utilization. This is the percentage of your overall available credit that you're using. The typical guidance is to keep this at or below 20 to 30%. So if your credit limit is $2,000 per month, that would mean spending no more than $400 to $600 per month on credit. Calculate this by dividing the amount you spend on credit each month by the total credit available to you. If you're unable to reduce the amount you spend on credit each month, one way to improve your credit utilization score is to ask for a higher credit limit from your credit provider. Importantly, you don't have to use this additional credit, but it can help to reduce your percentage credit utilization. The third point to improve your credit score is to check your credit report for any inconsistencies. You can view your credit report on sites like creditkarma.com or annualcreditreport.com. Ensure your history is accurate and consistent and shows things like the correct property addresses at the correct time periods of your life, and look for any mistakes or errors. This is important because lenders will use this information to cross-check to any applications you make for credit. And if there are discrepancies in the information, This can result in your application for a loan being declined. Reviewing your credit report can also, in the worst case scenario, identify fraud if someone's taken out credit in your name without you knowing about it. I had this a few years ago and I worked with the credit report agencies to correct my information and remove the incorrect credit card from my details. The other thing to watch out for is linked accounts. So if you've ever taken out anything with another person, such as a joint account, and you no longer need that account, then it's important to correct this information and give a notice of disassociation, as if the person you had a joint account with had a bad credit score, this could also impact your credit score as well. Fourth is the length of credit history you have. This includes the average age of all your credit accounts and also the age of your oldest and newest accounts. Showing a good history over a long period of time with a bank shows stability. This doesn't mean that you can't look for the best bank accounts or credit card providers to move to, but think about having a long-term account and then another account which you use to switch to the best terms every so often. That way you don't lose the record of having an account over the long term. The fifth point is your credit mix and to use a credit card responsibly. This considers whether you have both installment accounts such as a car loan, a personal loan or a mortgage, and also revolving accounts such as credit cards. Showing that you can manage both types of accounts responsibly generally helps to improve your credit score. However, only do this if you can spend within your means. For example, using a credit card on day-to-day expenditure for food shopping or transport. This will help to build up your credit score. The sixth point is try to avoid too many hard searches and space out any credit applications where possible. Hard searches are performed when you apply for credit, as the company you've applied to will check your credit report. For example, it could be an application for a mortgage, a credit card, or even a mobile phone. Too many hard searches can impact your credit score. Experian recommends one hard search every 3 months, so try to plan out any applications you intend to make so you can spread them over a longer period and not have them all in one go. And finally, number 7, try Experian Boost to see if it can help improve your credit score. Experian Boost takes into account regular payments like your monthly utility bills, your mobile phone contract or TV subscriptions as Netflix, and it helps to show that you're able to manage your money. Not all lenders will take it into account, but it's an extra step which might get you some additional points that move you into the best credit score band possible. The key is to be aware of your credit score and the things you can do to improve it, particularly before taking out a loan or line of credit so you can get the best deal possible. I hope this video has been helpful. Feel free to leave any questions in the comments and give the video a like and a subscribe, and I'll see you on the next video.